Yesterday afternoon, I did a interview with Sky on the major data in the domestic economy, or this side of the world in the last few days. There's been a lot. There's been our GDP numbers, there's been our trade numbers, and there's been the China trade numbers, which were out yesterday. I'll talk about that in a moment. First, I'll talk about the European Central Bank. It's absolutely the case that when Mario Draghi was asked about extending quantitative easing past March next year, that he said that it hadn't been discussed by any members of the Governing Council, which gave a pretty firm indication that the ECB will end quantitative easing next year. Mario Draghi in his presentation suggested that the Governing Council thought that inflation would increase quite apart from that, and really because of the oil price. They released, for the first time I can remember at the same time of the presentation, the outlook provided by the European Central Bank staff in terms of their forecasts. The growth forecast for this year is exactly the same as our model of the euro area, which we showed in the quarterly presentation, 1.7%. Amusingly, I thought they've got growth declining next year because they're worried about the decline in exports to Britain as it leaves the euro area. I think that puts the British in a stronger bargaining position than anyone thought. But they also had definitive forecasts for the oil price, and they think that euro area inflation will go up because of that. I think they've got a problem, and the problem is that they're going to attempt to leave quantitative easing at the same level of unemployment, about 10%, in which the Americans and the British got into quantitative easing. So I think what you're going to have is they'll stop quantitative easing, and then you'll have European QE2 and QE3, but I think that story will emerge later next year. Our GDP numbers, really interesting. The most interesting thing in them was not the growth, which was pretty good. It was in trend terms, it was 3.1% year on year, or 0.7% for the quarter. For the record, that was 0.1 or 1% lower than the forecast we put in the Bloomberg survey. We had 3.2 and 0.8. But what that really means is the growth outlook is pretty, in GDP terms, is pretty flat through the year. So you're going to get that 3% growth right through this year and into next year. The most interesting thing in the GDP number was what was happening to our export prices, the terms of trade. After those numbers fell by 2% in the first quarter, they went up by 2.3% in the third quarter. That means the terms of trade has stopped falling, it was flat. Now, if the terms of trade is flat, then that increase in GDP will work its way through into increase in national income. And that means that national income, which is growing at 2% for the year to the middle of the year, will be growing at 3% in a year's time, and will be growing at that 3% through next year as well. And that gives you a much better environment for corporate earnings, I think, in Australia as we go through the end of this year into next year, because national income, stronger national income growth will generate stronger corporate earnings growth. On the other hand, the outlook for interest rates is based on inflation, not growth, and the GDP deflator for households, which is the counterpart of what the Fed uses, grew by 0.1% for the quarter, or 0.4% annualised for the full year. That's very, very low inflation. If that goes through to the CPI, we'll definitely have the 2 more rate cuts that we anticipate. What did the trade numbers show? Well, the trade numbers show that the Australian trade deficit is falling from about $3.5 billion a month to about $2.5 billion a month this year. And the Chinese trade numbers showed us why. And that is that the prices that China is paying for its imports have stabilised, just like our terms of trade have stabilised. So they are importing more and more quantity, and because the price has stabilised, they're paying more and more for it. On our side of the ocean, we're exporting more quantity, and we are getting paid more and more for it. What's good for China is also good for Australian growth and national income.